Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN Sunday for Sunday, August 1st, 2021. We've got another great show for you this week. We'll be wrapping up all the news in retirement markets, technology, personal finance, so much more. And we've got members of the media, academia, and financial services to help us do it. So sit back, relax, enjoy this episode of BRN Sunday. Well, let's kick off the program with a look at what's going on the regulatory, legislative, and litigation front. Joining me now, they are better known as the Legal Eagles, but they're also known as David Levine, Kevin Walsh. Both are principals with Groom Law Group, an employee benefits law firm based in Washington, D.C. That's the Baltimore Me. Gentlemen, great to have you. Thanks so much for joining us this morning.
Jeff, thanks for having us. It's always good being on. And, with the Olympics going on, we're hoping we can put together a gold medal segment.
Well, I don't think there's any doubt there, David. You guys always put a Kevin and David, you guys always put together a gold medal segment for us, and you're winners regardless. So what's top of mind this week, gents? I don't know where I was going to go with that, but let's. I know you want to talk lifetime income policy and some of the new FAQ information about disclosures.
Yes, and I was going to describe this as synchronized podcasting. We hope to get a gold this Olympics. That's kind of our objective, hun. So since you threw in your ball, Maurice, I'll throw mine in too.
Absolutely.
But yeah, so lifetime income. We're going to talk a little bit about the policy behind lifetime income in a minute. But yes, the Department of Labor put out some very short, frequently asked questions this week. And it's good for the DOL to confirm some things. A lot of us had sort of taken a lot of these views and had some discussions, but it's really great that they put them out for us at this point because it sort of creates a nice level field and everybody has a clear picture. The big takeaway for me, cutting it to its basics, is 2 points. First, when do you need to give them? And let's talk about 401k individual account plans. For those plans, there was a lot of questions because the regulations came out and there was a question as to timing and everything. Boiled down, it's by the end of June 2022 is the first statement that needs to have a lifetime income disclosure on it. There was some concern you needed to do it this fall and people were rushing into that. But we had thought it through on our end, but it's nice to see the DOL really say, we've got some time, which is great as everybody gets their systems ready. Which takes us to the second point.
David, yes. it's more of an 800 meters as opposed to a 100 meter sprint here.
It's more like debating podcast 101 for the gold versus interrupting podcast 202 by Kevin Walsh for the silver.
Ouch. Sorry.
Hey,
go ahead.
Well, you could say ouch, but it's true. We do it to each other. So Kevin will certainly have his Olympic tortured reference as a retort for me, and I'll certainly deserve it. So I'm good with that. But number two, to wrap it up, and Jeff, by the way, thank you for taking some of our time up because, Kevin and I weren't sure what we were going to say. So this is great. See, we had to throw a little shade at everybody this week. It's kind of fun.
Appreciate it.
But anyway.
Thank you very much.
All jokes aside, number two is the idea of what is in the disclosure. The Department of Labor has its requirements. But as many people know, for a good period of time, a lot of vendors have been putting lifetime income projections or tools on statements that allowed people to sort of project their expected monthly income or annual income in retirement. And the DOL basically says, not much surprise, yes, you could do ours, but there's nothing stopping you from doing your own. So we might see some people who have their own versions of what lifetime income is and some other, as well as sort of the DOL mandated calculated version. There's been some tension and discussion about this because some people have said, is it going to cause confusion or not? I think that's died down a little, but I think it's still there for some. So we'll have to see. But more to come. Kevin, maybe it's much more interesting and really the portion of our segment that will win the gold. What's the policy behind all of this?
Yeah, thanks, David. And I think that was a great lead off, and I'm happy to anchor our segment here and hopefully get us to the finish line. But from a policy standpoint, I think the key here is that when we look at the defined contribution system, the 401k system, typically it's an area where people have, kind of the most savings they have anywhere. And there's this sense that folks look at the account balance and think, oh my gosh, that's a lot of money. I can probably live off of that and have a secure retirement. And at bottom, the fear is that, if you have an account balance with like $100,000 in it and you're approaching retirement, it seems like an awful lot of money. But on the other hand, when we look at, how much money you can live off of each year based on $100,000 account balance, it turns out that, you really can only spend some very, very small fraction of that each year if you want that money to last from, age 65 through end of life. So what this rule is designed to do, what these notices are designed to do, they're designed to make people think about, that account balance less as, I should go buy a new car, and more as I need to figure out how I'm going to manage this over a long period of time.
Wait,
so
Kevin,
I
have a question on that, because you say buy a new car. I thought it was for like taking a vacation of a lifetime and burning it all in one fell swoop.
Well, I think that's the risk, is that when we look at these account balances, they feel big, but they feel big in a way that if you spend it down quickly, it's not there, and it takes some reasonable financial planning and some of these assumptions based into these lifetime income disclosures as a way of encouraging folks to spend it down slowly so that it's there and helps provide a dignified retirement.
Gentlemen, how do you measure? Well, let me ask this. Instead of asking you how to measure success, this obviously gets rolled out, I think you said next year, so 2022, if I'm not mistaken. And is there a focus on, okay, we do this, we put this rule in place, how do we measure, and I'm saying by the regulators and the legislators, how do we measure that this is a success? Are they focused on, okay, we're not just going to do this, slap this on, regulation has cost to it, right, to do these, to either print or generate these things. So is there a way to validate, just like we would any communication campaign, that this is actually working?
That is a great. Go ahead, Kevin. You go first.
So that's a great question, and I think one of the tools will be surveys with folks and looking at the decisions folks make over the next few years with respect to their retirement savings. If we find, and I would assume they would do it through surveys if they were going to, but if data shows that account balances are holding up and they're staying higher further into retirement, then you could see this being successful. On the other hand, it could also be successful if we see folks shift into products like annuities, which are designed to provide lifetime income. So I don't think there's one metric or one study that's going to show whether this is successful, but I do think there's a hope that people will hold on to their savings longer.
David, thank you, Kevin. David, you want to jump in on that too?
Absolutely. We got to finish the last 50 meters here. And Kevin's right. Hey, we're doing as many Olympic analogies as we can this week. Next week, I think, is more track and field, so we'll use some track and field references then. But I agree with Kevin. I do think that sometimes we are challenged on determining success. I think a lot of things is we try, and some of it's a bit of a whack-a-mole game, but we try and see where it goes. The long-term benefit of these statements, I think some very basic data we'll see, are more people taking slower distributions over time, or are we still seeing the same number of lump sums? Also underlying a lot of this is the tension. If you look at what we did in the CARES Act, which for completely understandable reasons, we let people take out money for CARES emergencies. If you look at Secure 2.0, there's a bunch of different reasons, all of which are highly meritorious, to take out money while you're working for other purposes. So we're kind of fighting with ourselves. Do we want to give people access to our money now, or do we want to get them to stretch it out with lifetime income? And I think that's a battle we're going to see in ourselves and the entire industry for many years to come.
Yeah, and thanks for that. And I'll just point out, I'll just give my personal opinion is I think this is a great start, and I think kind of reminding people, it's like anything else in the benefits field. It's about communication, education, and reminding people what's out there and re-reminding, but not to the point where they just shut you down and put their head in the sand. Gentlemen, I have to tell you, we're going to award you the gold, silver, and bronze medals. Congratulations, the 800 meter. You guys are excellent swimmers, great anchoring, great start off the block. Have a great rest of the weekend. We'll talk to you again very soon.
Thanks, Jeff. Thanks, listeners.
Bye, guys.
Thanks, Kevin. Bye.
Welcome back. Now time to talk tech, consumer goods, and a heck of a lot more. We always blend our topics here on the program. Joining me now to discuss this a lot more, Daniel Klein. Maybe your name should be David. No, Daniel Klein. He is lead advisor, executive producer for Seven Investing. Dan, great to have you on the program again this morning.
Good morning, Jeff. Like me, you probably have not had coffee yet. I just did something I'm a little embarrassed about. I placed an Uber Eats order for coffee that cost me roughly $19 for a coffee and a pastry.
Wow, that's I don't even know how to comment. If people have comments, though, you can send them to Dan Klein at 7investing.com.
And that is Decline at 7investing.
Yeah,
DKLINE at 7investing.com.
There you go. And he will answer any question you have about Uber Eats and all the above. Okay, Dan, let's and my apologies for calling you David. Your segment actually follows the Legal Eagles, David Levine and Kevin Walsh, and so that was on the top of my brain. Dan, let's talk about Walmart. Really interesting story this week about offering college tuition to its employees. Really groundbreaking. So I want to get your thoughts on that.
Yeah, it's a really smart play. So Walmart had already had what it called its $1 a day college tuition, and that was a whole bunch of different college programs, generally in areas that would benefit Walmart. So degrees in like supply logistics and things like that. But you did have a small amount of payment as the worker. Now, Walmart is waiving that payment and they're covering your books. Why are they doing this? It's, of course, because Walmart is altruistic and truly cares about the No, of course not. It is because workers who become part of this program actually stay at Walmart longer. So, Jeff, as you know, I have a 17-year-old junior in high school, and he just started a new job at Wendy's, and he really likes it, and it's fun. But Wendy's is a franchise-owned company. It doesn't have these kind of benefits. And in the back of my head is, okay, next year when he's out of school and he's going to work for a couple of years before college, geesh, maybe he'll go to work at Walmart or Starbucks or other places that have similar college programs and take a couple of classes a semester.
Well, I think, Dan, let me kind of take it from the top down. Benefits are really important to people. That's one of the key drivers of people making job decisions, right? And one of the key benefits is healthcare. Retirement's another benefit, and then being able to get education and education support. Look, when I got my master's of business administration, I did it at night, and I got my employer at the time, and we're going back almost 30 years ago now. My employer actually paid for it as long as I maintained a B average. This seems to be a direction. If you want to go and get college educated, it's not a requirement. It's something that you may want to consider. This is a nice benefit to have, and I would think that would attract people to Walmart over a Target, a Costco, or Wendy's, perhaps, if they don't offer that program.
Yeah, absolutely. And I think you're going to see other companies match this. There are different education benefits and stipends and paybacks and all sorts of things. Starbucks is really the one that most directly does what Walmart is doing. But you're getting to the point where $15 is becoming the norm on a minimum wage. And Starbucks doesn't pay $15, but has all sorts of other benefits. If that's becoming the norm, you're not going to keep raising the minimum wage. You're going to look at other parts of work. And some of that's going to be flexibility, ability to control your schedule. And some of that is going to be perks like this. And I absolutely think college tuition, which, look, the reality is unless you go to a very top tier school in very specific fields, it doesn't really matter where you went to college. I went to Hofstra. If I told you I went to Hobart or University of Hartford, would you really know any different about which was a better school? It doesn't matter. Like it's not a thing. So the reality is, as a parent, I'm looking at, sheesh, would I rather take $60,000 to $80,000 and help my son buy a house and get his life started? Or would I rather pay college tuition? And the reality is, as someone with a non-academic kid who a degree is probably going to be necessary, but mostly perfunctory, I'd much rather Walmart pay for most of that, or Target, or even all of it. So I think we're at an inflection point as a society where how we view this secondary education, it's changing. And I'm not so sure it's going to be the norm to send your kid to these crazy expensive college programs, or like many of my friends and some of my colleagues taking on this huge amount of debt to end up with a degree that doesn't necessarily pay off. Like, sure, you go to Harvard Law School, you come out and you get a job that pays $300,000 a year. That might be worth it. You go to Hofstra Law School, that's not necessarily going to pay off.
It's interesting. Dan, you and I need to speak offline because I went to Hofstra too, although I'm older than you, so we need to kind of compare notes. Dan, let's
How
shift.
has that never come up?
I don't know. I don't know. That
We've
is
done this
so
for
odd.
3 years.
I know. It's odd. Dan, let's shift gears. Talk about Apple, Microsoft, Alphabet, which is the parent company of Google, reporting massive profits this quarter. What's it mean? Forget the stock buy, sell. Let's talk about what this means short term, long term.
Yeah, so it's important to remember that in the short term, how the market reacts to stocks and earnings doesn't matter, and that's why I wanted to talk about this. So Apple, put up some of the best numbers. All of these companies, Apple, Facebook, Tesla, they all put up these unbelievable earnings reports. But because of the pandemic, because of supply shortages, because of cyclicality of some of these businesses, they all basically came out and said, "Hey, things were really good, but they might not be as good next quarter." Now, if you're
Hmm.
looking at like, geez, we had double-digit gains across all categories like these companies did, it's not really bad news to be like, "Hey, we might only have single-digit gains. Things might slow down a little." But most of these stocks, most of the big tech stocks that reported, had pullbacks in the market. And the reason I wanted to bring this up is what happens in the short term has absolutely nothing to do in the long term. So when you have Amazon come out with incredible record growth numbers, basically there's a company that can be as profitable as it wants on whatever schedule it wants. And they say, "Hey, yeah, we're not going to grow quite as much because we had this unbelievable growth this quarter." That's not the same as saying we're going to shrink or we're going to do worse or we're going to have a bad quarter. But the market, in terms of the stock price, absolutely takes it as a negative. And as an investor, as a long-term investor, you really need to tune that out. Amazon isn't a bad company because all of a sudden it's not going to grow by 30% next quarter. Like, you can't endlessly grow. We saw this with Netflix. Netflix kept telling us, "Hey, we're pulling forward new subscribers. So at some point we're going to have a quarter that the growth numbers aren't going to look that great." Well, would you rather grow by 20 million subscribers in the first quarter and 2 million in the second? Or would you rather split that up 11 and 11? Well, you'd obviously rather have that 18 million extra subscribers for one quarter longer. So a lot of what you see with short-term stock price really has nothing to do with the business of these companies.
And and I want to reiterate that because so much of our focus as investors can be that short term number, right? But you and I both excuse me, for organizations that advocate for the long term. And so when you're buying a stock, whether it's an Apple, an Alphabet, a Microsoft, or XYZ company, you're thinking about that long. You should be thinking about that long term holding, not arbitraging. Not and that's kind of, Dan, where we get into that meme investing, right? Where people are just throwing money here, throwing money there, and it's kind of this. Maybe you get lucky, maybe you don't. It sounds more like one of your gambling excursions.
Yeah, if you're trying to guess short term what the stock market is doing, you're not going to win. Like, in the long term, you're not going to win because the reality is, I talk about this a lot. It's like betting on the second quarter score of a basketball game. It just doesn't tell you anything about the company. We've had a lot of bad stocks that will have a terrible report, and a charismatic CEO will talk about how things are turning around, and the stock will go up in the very, very short term, but it could also go down. There's no predicting it. There's no logic to it. It's betting on something that even the smartest prognosticators don't have any real insight. Whereas if you buy shares of a really good company, like any of the ones we mentioned, and I understand that there are some reasons people wouldn't want to own some of these companies. Certainly, Facebook falls into that, into that batch. But if you buy shares in any of these companies over 5 years, over 10 years, your returns are going to be really solid. So it's set it and forget it. Buy good companies and don't look at your portfolio. I don't think you're retiring tomorrow. And if you are, you should probably be making different decisions. So, stop viewing the stock market like you're playing roulette, like you're gambling. You're not gambling. When your barber gives you a hot tip, that's probably not a great idea. When you see people on social media talking about a stock, look, a lot of, and I'll use this word politely, a lot of dummies have been tricked into buying, AMC and GameStop because they're hot stocks and they have big movement. That is not a smart idea long term. It's not going to pay off. And if you make money on it, again, it's like if you throw down, money on the number 12 in roulette and it hits, that doesn't mean you're good at roulette.
Dan, you brought up barber. I don't have a barber. I don't know if you and I you've seen what I look like, so I don't have a barber. But I get the point. Really well taken. If someone who is not an expert is telling you to buy something, I would run the other direction. Dan, we're going to have to leave it there. Really good sound advice. I hope people are listening. I know I did, and I took a lot of notes while we were talking. Dan Klein, always a pleasure chatting with you. Enjoy your weekend, and we'll have to catch up soon on our Hofstra days. Again, I think I'm a little bit older than you, but be interesting if we overlapped it on who we know. Talk to you soon, Dan.
Go Dutch. I'll see you soon.
See ya. Bye-bye.
You need a financial plan that fits the way you want to live in retirement. A plan that can help grow and protect your money, now or in the future. With an annuity in your plan to help cover essential expenses, you'll have the freedom to live the retirement you want. This is what an annuity can do. Find the right financial professional to show you how. Learn more at protectedincome.org.
Welcome back, and now we're going to talk a little real estate, or a lot of real estate. Joining us on the line, he is real estate reporter for Market Watch, Jacob Passy. Jacob, so great to talk to you. Welcome back to the program this morning.
Glad to be here.
So I know yesterday was the 31st of July, and I think that brings some milestones I think you wanted to talk about.
Yeah, so the 31st of July was the expiration date for the CDC's national eviction moratorium. And, barring any somewhat unexpected developments from lawmakers in Congress, it is unlikely that is going to be extended again. Earlier in the week, the Biden administration signaled that they would not be extending it. And they related that decision back to a decision from the Supreme Court, where the Supreme Court basically ruled against a case that was seeking to have the eviction moratorium thrown out, citing the fact that it was going to be expiring soon. So basically, a majority of justices in the Supreme Court signaled that they would probably have chosen to vacate the moratorium, arguing that the CDC probably didn't have the authority to issue it, but they said that they were holding off on that since it was set to expire anyway. So given that the Biden administration chose not to extend it, and the technically speaking, Congress could pass another one. They have that authority to do so. But as of Friday, it was looking pretty unlikely that enough lawmakers were going to get together and corral to do so. So now the situation is looking somewhat bleak for a lot of people across the country.
Hey, let's talk about what happens next. So the eviction moratorium ends, and if do we see a rash of litigation now, or court cases where people now have to show up I'm not familiar with the process, but is there an eviction process in every state, locality that they would have to follow?
Yeah, the eviction process varies from state to state, locality to locality. But yes, you're right. There's going to be a wave of litigation as a result of this. You're going to see landlords moving in many parts of the country. They're going to move as quickly as possible to evict their tenants who have not been able to pay rent during the pandemic, during the time that the moratorium was put in place. And, it's not like overnight those tenants will be kicked out of their homes, although studies show that oftentimes when a tenant finds out that their landlord has filed for eviction against them, they opt to move even though they don't have to. So typically, the way it works is that, the landlord has to give some sort of notice to the tenant, and they, have a period of time after that notice. And then there's usually a court case, and the tenant has the right to defend themselves in that case. And then the decision is made, and the tenant either is asked to leave the home, or perhaps they win the case, depending on the situation. And usually they don't have to leave right away, but again, that varies from state to state. It's usually carried out by, a sheriff's deputy or some other law enforcement official, and, entrusted by the state with carrying out that, eviction. And yeah, so that's how it goes. Like I said, lots of people choose to leave their apartments or homes before they have to, perhaps because there's a misunderstanding. Right now, it's also, it's a tough situation because, a lot of people are going to be kept in limbo, including landlords, for quite a while because a lot of courts are still operating virtually, or, there's just not enough capacity in the courtrooms to deal with this. So there's going to be a backlog of cases in many parts of the country, and that'll just extend the timeline. And unfortunately for the tenants involved, this could be kind of a lasting, blight on their ability to find good housing. If you have an eviction case filed against you, it appears typically on your, credit report or background check. And so other landlords, if you apply for other housing down the road, will be able to know that an eviction case was filed against you, even if you win it. Just the sheer existence of that will cause a lot of landlords to not want to take you on as a tenant. So this could make it much more difficult for many Americans, millions of Americans, to get housing moving forward. Now, there still is emergency rental assistance being rolled out nationwide. And, if tenants and landlords get access to that, there's been lots of criticism since those funds were approved by Congress that it's been so slow to get out to people. And still not a majority of it has made its hands into renters, unfortunately, or landlords. So, you can still apply for those funds if possible. And, there's nothing that prevents, federal agencies perhaps from taking action. They could theoretically choose to create their own eviction protection separate from the CDC one that expired. Also, other states can, individual states and cities can enforce their own eviction moratoriums. And there are ones that are going to continue after this. New York, for example, has one that extends past the CDC one. So does California, I believe. So some renters in certain states and cities may still be protected by the local or state moratorium, even though the federal one is no longer in effect.
Jacob, we did a story on Friday about on the network about affordable housing, and that seems to be decreasing. If people are evicted and then they're looking for another, or they just moved, maybe they don't have that eviction mark on their credit report or whatever, wherever it goes, it's going to be a lot more challenging to find, renting an apartment or a condo or a house, right? Those because of where we are with the supply, that becomes even more challenging. So the people who are already in financial strife could be facing more financial strife trying to find a location to live.
Completely. When you talk to consumer advocates, the biggest concerns they raise are that a lot of these people are not going to be able to find housing right away, if at all. So a lot of them are going to become homeless, and that doesn't necessarily mean living on the streets. We forget that, you can be homeless if you're couch surfing or living out of your car or something like that. And that's what a lot of these households are going to be forced to do once they are displaced because of an eviction proceeding against them. And, it can take a long time to recover from that. It's also unclear how the landlords are going to emerge from this, because keep in mind, an eviction proceeding, that costs money for a landlord. They have to, maybe they have a lawyer on hand on retainer, but otherwise they have to hire a lawyer, pay that lawyer's fees. So that's an expense. And it's not like the apartment is filled overnight. And, depending on the market, some markets, there may be really tons of evictions going on, and it's not clear that those people will all be able to find housing right away. And as long as your unit is, sitting vacant, you're in a bind. And even if the tenant is out of the unit, you still, theoretically, as part of the eviction judgment, the tenant could be required to pay back rent to the landlord, but that's not guaranteed. And even if they are required to, you might have to hire a debt collector or someone else to actually go get that money from that tenant. So this is all to say that, the whole situation in rental housing has been really complex for the past year. And lots of landlords are struggling, especially smaller mom and pop landlords. The National Rental Home Council has put out statistics about how, a significant percentage of small mom and pop landlords who only own, maybe a handful of rental properties, they, first of all, make up a significant share of the single-family rental market as opposed to apartments. But a lot of them have bailed out, basically. They sold off their properties and exited the market, and oftentimes those properties are being sold to people who then choose to live in them themselves rather than renting them out to tenants. So the rental housing stock could shrink because of this whole situation, and that's only going to exacerbate the situation with affordable housing.
Well, like anything else with this pandemic, it's not over and done in just fell swoop. So we're going to have to see how this all plays out. Jacob, it's always a pleasure chatting with you. Thank you so much for joining us, and we look forward to having you back on the program again very soon.
Talk soon. Take care.
Bye-bye. Welcome back. We're going to close out the show now with a look at markets. And joining us on the line, you will certainly know his name, and you will see him on the TD Ameritrade Network. He hosts two shows there, Markets on the Close and Morning Trade Live. We're talking about Oliver Rennick. Oliver, so great to talk to you. Welcome back to the program this morning.
Thanks, Jeff. Appreciate it.
Always good to get your assessment. You are knee-deep in markets, market data, economic data, cryptocurrency. What's your lay of the land, given that the Federal Reserve had some conversations and talking interest rates and mortgages and you name it?
My big focus for the last 2 months now has been analyzing the response to the June FOMC meeting. So we just had the July FOMC meeting this week, but the market has been very specifically oriented in a unique way since mid-June, which was when we last heard from the Fed in a hawkish way. For those that need a reminder, the June FOMC, June 15th and 16th is when the Fed board members moved up the dot plot of expectations for the path of future interest rate levels. And since then, the market has taken on a very, very different tone. So when you look at the year-to-date action in just about any asset class, you're going to notice a very specific turning point around June 15th, literally as soon as the Fed did push that dot plot forward a little bit. And what's happened since then has been the bond market rallying, yields going down, but specifically the bond yield curve flattening. So long-term bond yields are going down faster than short-term bond yields, in which some short-term bond yields actually have gone higher. If you look at the very short overnight rate, given that the Fed's forward push of the dots raises the odds of a hike, if you look at 90-day interest rates or if you look at a 2-year, you're actually going to see that yields are fairly elevated still relative to where they were pre-FOMC in June. So that's really important because the bond market totally took on this unique dynamic after that FOMC. At the same time, the dollar rallied and has generally been fairly strong since then. But then this week, what happened is you had some attempted reversal of all these things. So over the last month and a half, while the bond yield curve was flattening after the FOMC and the dollar was higher, the stock market also skewed back very specifically to growth trades, the NASDAQ over this Russell, and tech companies over reopening themes. So then fast forward to this week, and now Powell is on his own here. This is not a week for the dot plot. This is his opportunity to communicate what he wants to, and he communicates a very dovish message. So trying to basically undo what happened after the last FOMC. So as a result, we see some reversal in the things from the last month and a half, or I'll call it 2 months now, basically. And that was the dollar fell this week. You saw yields kind of move, but I'll get to that in a sec. You saw the dollar fall. You saw the tech trade slow relative to reopening stocks, but bonds basically did the same thing. Bonds tried at first to widen out the yield curve, but it didn't really stick. So it seems to me then that the market is actually sticking with the June FOMC message and is right now actually still tilted more towards thinking about what the Fed could do to tighten policy. So a lot of people right now are going to tell you that the market is signaling it's very happy with the Fed policy, that it's convinced inflation and yields are going to stay low. However, they're basing that largely on the fact that the stock market has continued to go higher. But there are a lot of reasons the stock market could be going higher that maybe are disconnected with the reality that the tapering timeline or interest rate hikes could come sooner than expected. And so that's where I believe there is still a good deal of attention here in this market where stocks might not be taking the right message, that the bond market is preparing for some degree of either faster tightening than expected or a slower economy than expected. Those are basically the two explanations for why the yield curve has done what it's done. There's a third explanation that, long-term yields are just reflecting the fact inflation is going to stay low for a long time, but that for me is a really hard argument to swallow when right now inflation is surging past every expectation while the economic data is actually missing expectation. That's a bad combo. So that's my overall framework that I'm working under right now.
Oliver, you bring up inflation. Many Americans buying gasoline, many Americans buying food, seeing prices go up. What's the takeaway from, I know that your show really kind of focuses on the retail investor, but you bring in a lot of macro. What about mom and pop out there, labor people like us, have to buy goods and services, seeing these costs go up? I mean, that has to temper some expectation. I saw somewhere maybe consumer confidence a little bit, up, but a little bit more tempered, a little bit more muted.
Yeah, that was today. We had consumer sentiment, and it has at least now leveled off a little bit. It did drop from the previous month, but that was already understood in our first look at the Michigan sentiment number. We saw that inflation expectations from that sentiment number were slightly by about a basis point lower than the previous reading, but still elevated as consumers expect 1 year inflation of about almost 5% still. So, the thing is that prices are definitely going up, but it hasn't mattered so much because people have more money.
That's
so
true.
This is kind of one of those issues where we see it, but if we went out to get a lobster roll and it's $35 instead of $25, I mean, what are you going to do? Not get it? So I think that at this moment, because people are still generally very flush with cash, as we saw, personal income again was positive this past reading on Friday. We got that reading as well. That generally, with the market up, stimulus checks and family aid still working its way through the system. That stuff hasn't run out yet. So a lot of this inflation is not inducing any type of panic, but that could change very quickly if, for whatever reason, people are not as well off as they are right now. That could be stock market that pulls back. It could be just an over exuberance of spending where people do not manage their finances properly, and maybe there is a surprise on the stimulus side where we don't get as much as we expect. So there certainly is risk in that, even if right now people are able to kind of ignore those higher prices.
I'd be remiss, Oliver, if I didn't ask you about cryptocurrency. Bitcoin, Tether, Ether. Where do you see the crypto market? How does that shape up relative to what's happening in the what I'll call the traditional stock market, traditional bond market?
Yeah, Bitcoin's really interesting right now. It's mostly the one I focus on, as so far throughout the existence of cryptocurrency, you've really only needed to have a grasp on Bitcoin price direction to understand where the other prices are going. Ultimately, all those other tokens are still high beta to Bitcoin. So I don't pay attention to them too much. I mean, there's definitely interesting things happening in that realm. Mm-hmm. But from a market standpoint, most people are not trading those lesser coins outside of kind of Bitcoin, Ethereum. So yeah, my focus remains on Bitcoin, and generally I just approach it from a very technical, and what I try to have is a logical basis where I'm just watching the numbers and the charts, and after it failed to really break down through 30,000, that seemed like it would really create an opportunity here for a powerful rally. That's where our coverage was over the last month and a half, preparing for a higher probability of downside than upside. But as soon as Bitcoin did not find sellers on a slight dip below 29,000 a week ago, or below 30,000, it was pretty clear that was going to ramp back up. So the question now is it a short-term squeeze of people who are too short, a relief bounce, or is it the start of a broader move? We had Ari Paul on from Block Tower today, who believes that this likely is more the start of a broader move, but also recognizes that a Fed that is more willing to taper or hike rates is going to be bad for Bitcoin. So I think that's also another piece of evidence here in the market that points towards the general path towards tightness that the Fed is going to have to take. Even though there's always talk about transitory, ultimately over the last 6 months, the Federal Reserve has had to make a slight marginal, even if it is marginal shift towards a hawkish language. That's not going to be good for Bitcoin, because Bitcoin's whole entire narrative is about the Federal Reserve letting everything go up in flames. So the more responsible the Fed is, the lower Bitcoin's going to go. And that's really all that matters for it. So it's not surprising in that context then to see it also have a good week leading into a very dovish message from Powell. But if you get a hotter inflation print, you're likely going to see Bitcoin come under pressure, because the Fed is telling us that they're ready to act maybe a little bit more soon than people recognize. So, yeah, for Bitcoin, you need to get a hot inflation print, and you need to have Powell coming out saying, I don't care about that inflation print. But that's not what he's saying. He's actually talking out of both sides of his mouth, saying, I do care about the inflation print, but I'm not going to do anything about it just yet. And then the other people around him are saying, no, we are going to have to do something about it if it gets out of control. So none of that is really good for Bitcoin, because Bitcoin needs just total rampant callousness from policymakers.
Oliver, you have to be part body language reader and language expert in your role. Really interesting, interesting dynamic you have to follow. Well, folks, Oliver, I want to say thank you very much. And folks, if you want to check out Oliver each and every day, he does 3 hours in the morning on Morning Trade Live, and 3 hours, I think, in the afternoon, markets on the close. 2 and 2. I'm sorry. Well, you're like Chuck Woolery. Yeah. Anyway, Oliver Rennick, always a pleasure chatting with you. Have a great rest of your week, and we'll talk to you again very soon.
All right, thank you.
Bye. Well, that wraps up this episode of BRN Sunday. Have a topic of interest, somebody you think we should talk to, drop us a line. And don't forget, for all the information in retirement, markets, technology, personal finance, so much more, check out today's edition of our daily newsletter, The Morning Pulse. We're back again tomorrow, this time for BRN AM. We'll have a very special guest. So until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.